So variable consideration, what are we talking about here? There's generally a fixed agreed upon price, but a lot of times you will have things that will make a difference in what the price ends up at. First thing we have to think about trade discounts. These are reductions from the list or catalog price. These we do not account for. This is like if you went to buy a car, and would you just go in and say, oh yes, I'll pay the list price? No, you negotiate down to a transaction price, what you actually pay. That is where we start the accounting. So trade discounts, it's so companies don't have to change their catalogs and have a bunch of different prices. They can negotiate their prices with each customer if they want to. So the trade discounts, reductions from list or catalog price, not recognized in the accounting records, which is good news for us because we don't have to worry about it too much. Okay, cash or sales discounts are different. These are they're designed to have customers pay more promptly. You can take a 2% discount if you pay within 10 days. You have to pay the whole thing by 30 days. So it can be 210 net 30, it could be 315, you know, whatever the terms are. Most of what you have done in AC 102 would be using the gross method. Here we introduce the gross method and, well, we review the gross method and we'll introduce the net method. So I'd like to look at brief exercise 7.2. Okay, so here's brief exercise 7.2. It's somewhat bigger, so you might be able to see it. So this company uses the gross method to record credit sales. June 1st, it made sales of 50,000, terms 315, net 45. On June 12th, they got full payment. So what does this end up looking like? On June 1st, we simply book accounts receivable of the full 50,000. And then when they pay within the discount period, this is within 15 days, the account receivable is satisfied, but they're only going to send a check for 48.5, which is the net amount. And so we're going to debit our sales discounts, and we're done. Okay, that's what you did in AC 102, no problem there. The net method is the company makes the assumption that everybody is going to take the discount, and so they book it a little bit differently. They book it at the net amount. So if we look at 7.3, what they would do with the net method is this. It would simply be accounts receivable, the 48.5, the net amount, sales revenue, 48.5, and then cash at accounts receivable, and the 1,500 is, you know, they just assume that all the companies will take it. Okay, so now, if Wiley had any sense, they would include this in the problem, but they don't. An obvious question is, well, what if they don't pay? Then what do we do? Okay, and so what we do there is, make a little bit more room here. So this is, just say they didn't pay until 6:30, okay? So now they've got to send in, let me just get this a little bit better. They've got to send in 50,000 because they didn't take the discount within the proper amount of time within the 15 days. So now we obviously can't have a journal entry like this, so we got to stuff the 1,500 over here, and this is going to be a sales discount forfeited. You can just say sales discount lost, but you should know forfeited because I'm sure that would be, you know, if you transfer or take the CPA exam, they probably won't want a simple word like lost. But this is a sort of an other revenue account. It's a, you know, sales discount forfeited. Okay. Now, are you going to run into the gross method? Probably not. I mean, I'm sorry, are you going to run into the net method? Probably not. Most companies use the gross method just because it's easier. It makes more sense to the bookkeepers. It's you know, it's just easier. Now the net method, accountants like it better because it reflects more truly the economic substance of the transaction. The cash equivalent price is that 48.5. That's what they should buy it at. To not do it at that price, it's really kind of reflects poor management. If you figure out the interest rate on not taking these discounts, it's significant. Okay, so anyway, you need to be aware of both the gross method and the net method and how they work. Okay, the other thing is sales returns and allowances. Let's look at brief exercise 7.4. And this is another of the sort of variable consideration where your transaction price may vary depending on future events. So here they've sold 9,000 of shelving to this office supply company, and so far, and they don't put dates on this, which makes it a little bit, I don't know. Anyway, they've already granted an allowance because some of the shelving didn't meet exact specifications, but it could still be sold. And then at year end, it estimates it's going to have an additional amount. So we do the accounts receivable, the sales revenue, okay, no problem there. And sales returns and allowances and accounts receivable. In this case, it's an allowance. And so that makes sense. Now, when they come to year end, and this really should have a, you know, sort of a year end date on it to indicate that's what we're doing. They've got expected allowances of 200 that they think will be granted. So in order to keep the whole transaction together and to reflect the transaction price properly, you're going to book those sales returns and allowances now, but you don't reduce the receivable because nothing's happened yet. So here's where you have your allowance for sales returns and allowances. Okay, only accountants could make these things up. All right, so just you have to be aware of how that works. Okay, and then I think they talk in the book about the time value of money. That's probably, yeah, you could take a look at that. Okay, so I think that's, is that it for that? Okay. I thought there was something about the time. I've lost it. Oh, here it is. It's over here. All right. Yeah, this is a really, if I knew how to edit, I could take this stuff out. Okay, they also talk about the time value of money. You have to measure your receivables at the present value, you know, so that you're separating out the sales revenue versus the interest. Okay, so we have recognized our accounts receivable, and the next thing we have to do is value them. So that will be where we go next.